The annual inflation rate in the U.S. slowed to 2.9% in July. That's the lowest since 2021. The figure also lowers hurdles for a much-anticipated rate cut in September. Let's turn to Professor Kim Sei-wan for more. Good morning.
Good morning.
So the latest CPI figure paves the way for a rate cut in September, doesn't it?
That is true. In retrospect, U.S. annual inflation skyrocketed up to over 9% in 2022, but inflation declined down to 2% level in July thanks to U.S. Fed's higher interest rate. So that means that most of the inflation pressure disappeared, and inflation came down to Federal Reserve target range. At the same time, since U.S. labor market is underperforming, interest rate cut atmosphere is perfect. It is almost 100% expected that U.S. Fed cuts its key interest rate in September's FOMC meeting.
So interest being shifted from inflation to the labor sector you just mentioned, is it because inflation is now under full control, or is it because the labor market is really bad, or is it both?
I think both are reasons of monetary policy focus is shifting from inflation to labor market. Mm-hmm. In the last 2 years, inflation was high, but labor market was pretty hot around the full employment in the United States. But U.S. economy situation became almost the opposite between inflation and employment from early this year. Inflation became pretty much under control, but employment is not robust compared to before.
Well, then tell us, what's driving the poor labor market over in the States?
The U.S. labor market for this year has shown signs of continuous underperformance compared to previous years. For example, non-farm employment in July added only 114,000 jobs, which is much less than expected and smaller than previous month. This can be attributed to several factors like Federal Reserve, higher interest rate, economic uncertainty related to geopolitical issues like the war in Ukraine, and some sectors, particularly technology, have experienced significant layoffs as companies adjust to post-pandemic situation. These factors combined have led to a labor market, while still adding jobs, is doing so at a lower pace than before.
Well, it looks like a rate cut in September is a given one for now. But the question is, how much of a rate cut is expected in September then? I mean, there are divided opinions. A quarter percentage point or even a big rate cut. What do you think?
Previously, almost 100% of market's expectation was on a 0.25% cut in September's FOMC meeting. But as time goes by, inflation is lower than expected and employment is also lower than expected. So a 0.5% interest rate cut in September, expectation gets stronger because it became more important to support labor market. But I believe that U.S. Fed is more likely to cut its key interest rate by a 0.25% in September because it is the first rate cut in 2.5 years.
Right.
So U.S. Fed would be very cautious on the rate cut's impact on the economy. And if everything goes well without a major shock to economy after September's interest rate cut, U.S. Fed will cut its rate by a 0.5% in November's FOMC meeting, depending on labor market situation.
Right, we are still a month away from the rate cut in September, expected one in September. Now, before I let you go, Professor Kim, does that mean no rate cut yet for the Bank of Korea next week?
Actually, KDI, government think tank, is suggesting a preemptive interest rate cut in August, which is next week. They argue that domestic consumption investments are weakening due to higher interest rate of the Bank of Korea. But I am pretty much sure that Bank of Korea will cut its rate. After seeing U.S. Federal Reserve interest rate cut in September, related to interest rate cut early in Korea, Bank of Korea believes that lower interest rate in Korea could trigger an unstable foreign exchange market by raising $1 exchange rate. The size of Bank of Korea's interest rate cut in September would be a 0.25%.
which means a possible rate cut in October for South Korea. All right, Professor Kim, thank you so much for your time today.
Thank you for having me today.